How to reduce risks in institutional trading. Institutional trading involves prominent positions, multiple brokers, and complex systems, so effective risk management is essential. Institutions implement best practices at every stage when dealing with equities, derivatives, or crypto assets. A robust risk management plan is needed to avoid trading errors, losses, or regulatory breaches. 1. Broker and custodian coordination. Clear coordination among brokers, prime brokers, and custodians is the first line of defense against trading risk. Delivery versus payment, DVP. Settlement ensures that securities and cash exchange simultaneously, removing settlement credit risk. This way, trades settle only when both sides deliver and prevent counterparty default during settlement. Automated messaging through systems like SWIFT or DTC transmits trade and account details efficiently between parties to help reduce miscommunication and delays. Global custodians also provide local expertise and emphasize the importance of accurate and timely communication. Daily trade and position reconciliations between each broker and the custodian help catch discrepancies early to keep the firm's books in alignment and prevent settlement failures. 2. Trade execution and reconciliation. Managing execution risk requires reliable systems and strong oversight. Institutions use algorithms and multi-venue routing to efficiently reduce slippage and fill large orders. Pre-trade controls ensure that orders meet internal risk parameters, while post-trade allocations confirm proper distribution across client accounts. Intelligent order routing and execution algorithms help ensure best execution, adapting to liquidity conditions across venues. Electronic trade confirmation (ETC) systems enable straight-through processing for trades to flow directly from execution to clearing without manual input. Automated reconciliation systems then match trades across internal and external records to detect and resolve mismatches early, minimizing the risk of booking errors or failed settlements. 3. Broker execution and clearing coordination. In institutional trading, it's common for the executing and clearing brokers to be different. This structure gives asset managers flexibility in routing orders and allocating trades. Still, it also introduces operational risk if not tightly managed. One scenario where this comes into play is when an executed trade is handed off from one broker to another for settlement, which is called the give-up trade. Understanding the definition of give-up trade is important because it highlights the precise coordination needed between all involved parties. Errors in trade instructions, mismatched account details, or delays in affirmation can all lead to settlement failures. Institutional firms mitigate this risk using pre-agreed terms, automated trade matching systems, and daily reconciliations between trading desks, clearing brokers, and custodians. The give-up model allows fund managers to centralize clearing operations while engaging multiple executing brokers to access various liquidity pools or regional markets. This model benefits large institutions trading across time zones or asset classes. However, the complexity of reconciling these transactions in real time requires both counterparties to maintain synchronized systems and workflows. Missteps in processing give-up trades can result in trade breaks or regulatory issues, making establishing standardized instructions, strong operational controls, and clear communication protocols crucial. 4. Operational workflows and automation. Firms integrate front, middle, and back-office systems to reduce manual errors and boost efficiency. Centralized order management systems, OMS, automatically route orders, trigger allocations, and link to custodial instructions. Straight-through processing, STP, platforms support high trade volumes with fewer breakdowns by minimizing the need for manual intervention. Connecting OMS, EMS, execution venues, and accounting systems helps streamline workflows from order capture to settlement. Exception workflows flag and resolve issues in real time. At the same time, centralized dashboards provide better visibility into operational and compliance data, enabling faster decision-making and reduced risk exposure.
If you found this video informative and useful, we'll always bring new concepts explained for you, so stay tuned with Sprint Seal, and if you like the video, do share. If have any doubts or queries, do let us know in the comment section. Use the coupon code YouTube10 in our website to get 10% off on all our courses.